let's start off with you, Peter. We've had so much economic data that has really pushed us, basically in either direction here in South Africa, but we're mostly looking at the non-farm payrolls in the US at this point in time in terms of some kind of risk appetite, risk aversion. And on the other end, we know that the PMI number is quite pivotal in today's trade as well. Let's start with manufacturing. Are you expecting South African manufacturing numbers to stay above 50?
Yeah, I think it should just about to hold in confidence at the moment. I think the key problem here is clearly the outlook and what's going on in Europe, and the South African manufacturing base is still pretty exposed to Europe, though overall, comparing it obviously to a lot of other emerging countries within this time zone, it's not quite as bad, with obviously some good diversity via commodities into Asia as well. But you're right, there is definitely a lot of data to get our heads around, both on the domestic front with the impact on the SAR, but also globally. I think increasingly the rand we're seeing is linked to, for instance, the S&P and risk sentiment more generally.
Donald, we seem to have started the year with lots of impetus. We saw those PMIs here in South Africa and in China above 60 back in February. Looks like we've lost a bit of that momentum though as the year progresses. Number of factors, we've got Europe, we've also got the rand, which at current levels could be standing in the way of the manufacturing sector. What's your view?
Well, yeah, I mean, you get the sense at the moment that this market's kind of looking for bad news, and every little bit of bad news that comes out, it grabs it, and then you see another sell-off. And this hasn't been the only piece of negative economic news, and I think it's really starting to put some question marks around the global economic recovery. I don't think you're going to find China going into recessionary conditions, but the question is whether China will be able to sustain economic growth globally, will actually be able to be that driving force. And that's what the questions are. And then, if you look at the economic data that's been coming out of the United States, also some concerning indicators there, particularly on the leading indicator side. The consumer confidence number that came out on Friday was very concerning.
Peter, just looking at the economic growth expected here in South Africa, we're talking about a GDP figure of around 3%. We had President Jacob Zuma talking about the contribution of the World Cup to GDP of only 0.3%, and the number that we were kind of hearing prior to the statements was around 0.5, 0.6%. You're of the view that the World Cup could contribute 0.7% to GDP.
Yes, but our view on that is basically a full year view, and part of that is basically tourists coming in the second half of the year, given that prices have increased so much during the World Cup. And if you're looking for actual impact during the World Cup, then we are actually only talking about 0.3, 0.4. So our number is more the indirect benefits as well, how we calculate that. But I think the market's going to have an interesting time in the coming months digesting the World Cup data, because I think we'll see basically manufacturing and retail sales moving in opposite directions. On the one hand, as people take time off work, as productivity drops with the World Cup, you can well see manufacturing data move back from perhaps a high next week of around 7.5% back to say 4% for June and July, whereas retail sales may well increase to around 15-20% year on year. So these two offsetting factors, I think, have to be looked through by the market to see the underlying picture for the economy.
Well, Peter, just looking at your growth expectations for South Africa, and we've discussed the rand a number of times with you on the programme, and you think it's on a longer-term weakening trend. But at current levels, you seem to think also, you wrote this in Business Day this week, that there is an opportunity cost to our economic growth from having the rand at current levels.
Yes, exactly. I think it's important to remember that the level of the rand is an offsetting factor to a number of different structural problems that South Africa faces. It's not a long-term solution to a lack of competitiveness, but in the short term it can offset for exporters, for miners and manufacturers, the high wage growth, the electricity price increases, things like that. But I think South Africa needs to realise that you can get some impact of a weaker currency, and that's perhaps why there is such strong pressure from the left in government for a change in currency policy, I think.
Do you think the government should hold on and wait before they create some kind of pressure valve when it comes to the local currency, Donald? Because at the end of the day, we know that when the World Cup is over, we've got to actually sit back and see where we're going from a currency perspective, and of course from a foreign inflow perspective as well.
Well, I mean, there's two answers to that. I think the first one is, what exactly can the government do to impact the currency. Just how effective are they going to be there? And if they were to actively get involved in the currency markets, that can have some negative repercussions as well. The second point is there's a bit of a school of thought that we're going to have a bit of a post-World Cup hangover. So particularly leading to in terms of what's going to be drivers for the South African economy over the course of the next few years, considering that the main driver for the South African economy over the last 4 to 5 years has been this lead up to the World Cup. So I think at this particular point in time, it's probably best to adopt a wait and see approach before any major policy decisions are made.
Peter, your view on that, and could you also explain, you do mention in your article that to achieve a weaker dollar we could sell dollar puts into the market, much the same as Mexico has done. What sort of success would that achieve, do you think?
Well, I think there are two key points around the change in currency policy. The first one is basically the signalling impact, the signal to the market that the government does want to do something about the currency, and that can change investors' mindsets and make them think twice about the level and the flow of long-term real money investments in South Africa. And then there's the real impact from any change. So I think the good point about an optionalized basically reserve accumulation process, which is what this Mexican idea is, you basically allow markets to accumulate reserves on your behalf throughout a month, and then you take it at the end of the month via an option contract. And I think the good point about that is it is a very low-cost solution for the SARB. The hedging costs would be are given up to the bank. They undertake those hedging costs, which reduces volatility. And there has been some success in Mexico, both in terms of lowering expected vol in the volatility markets, and also actualized vol as well, as banks undertake this hedging process. It's not a magic bullet, certainly, but I think it will help contribute to the SARB to increase their reserve accumulation, which is currently at levels that are too low, really, for the market to have any confidence that this process can weaken the currency.
Peter, it's also said that South Africa remains relatively uncompetitive, and one only has to look at the most recent wage negotiations that we're faced with. Of course, Eskom still unable to reach a decision with the unions at this point in time, and of course we know what happened with Transnet. Couldn't that be a dampener in terms of what we'll be seeing from a foreign demand perspective when it comes to South Africa? So perhaps we shouldn't be too quick to move with regards to intervening in the local currency.
Well, I think on that point, it's an offset. I mean, if you're seeing large wage increases, I mean, it's clearly putting off FDI investors. And speaking to a number of companies who are looking to invest in South Africa, it is these sort of bottom line issues such as wage growth, electricity price, and supply side issues that are the concern. And I think also we have to remember we're at the bottom of the cycle. Inflation is going to increase with it, wage demands and real wage demands as well on the back of that. And I think South Africa also has to sort of position itself strategically as well in terms of a mining sector that is not at the peak that it used to be sort of 5-10 years ago, and finding other sectors which are probably capital and labour intensive going forward, so which requires a lot of external investment.
Well, Donald, of course, it's not the FDI, but the carry trade that's been supporting the rand at current levels. Going into the second half of the year, do you think we're going to continue to see those flows coming into South Africa?
Well, I think certainly if you're going to continue to see low interest rates overseas. Interestingly, though, there are questions around just how profitable a carry trade could be, because basically, you're entering into a position where you're taking money from, for argument's sake, the Japanese market, and over a period of a year, there might be maybe a 5 or 6% interest in it. Now, if you watch currencies, you can be in a situation where if you're long the one currency, short the other, over a period of 2 weeks, you can find yourself down 5 or 6%. So, there's different schools of thought around how much impact that has on the currency. But I think, as long as interest rates are at the kind of levels that they are, you will see some investors and speculators out there trying to take advantage of it.
Okay, Peter, some last words before we say goodbye to you. Just looking at the World Cup at this point in time, who do you think is going to win in tomorrow's session? Of course, this being far more important than the currency market.
I think the currency markets will probably be looking elsewhere at what's going on in the S&P at PMI in China and that sort of thing. I perhaps have a small flutter on Argentina making it the whole way, but I wouldn't want to commit to that too strongly.